In a world where wealth seems like a distant dream, few manage to uncover the path to financial success. Imagine if there was a key, a simple method that could accelerate your journey towards prosperity. Warren Buffett, one of the most renowned investors on the planet, has revealed a powerful strategy that can change everything in just 6 months. But what exactly does he do to achieve such astonishing results? Before we begin, write in the comments, "I am ready for my financial transformation." Think about how many times you felt trapped in a cycle of financial struggles, not knowing how to break free. Now, picture yourself breaking those chains and achieving financial freedom. This is the promise that this strategy offers. But don't be fooled. It's not just about luck or talent. It's a combination of discipline, knowledge, and the right mindset. Are you ready to challenge your beliefs about money? Over the next few minutes, new ideas and insights may arise, leading you to question everything you know about investing and wealth building. This is the moment to open your mind, to leave the past behind, and to embrace a promising future. Stay tuned, because your financial transformation starts now. Identifying investment opportunities is an essential skill for any investor looking to maximize their returns. One of the first steps in this process is analyzing sectors and companies that are undervalued, meaning those whose stocks are trading below their real value. This analysis might involve observing market trends, technological innovations, and changes in consumer behavior. By focusing on emerging or recovering sectors, the investor can discover companies with great potential for rapid growth. However, it's important not to be swayed by emotions or tips from others. Identifying opportunities should be based on concrete data and in-depth analysis. Tools such as sector analysis reports and market studies can help in understanding which companies are positioned to grow. Additionally, keeping an eye on economic and political news that could impact specific sectors is crucial for gaining a clearer view of the investment landscape. Another interesting aspect is the use of economic and financial indicators that can signal opportunities. For example, an increase in sales in a particular sector might indicate an economic recovery, suggesting that companies in that sector could see their stocks appreciate. Thus, the ability to observe the market and interpret the signals it offers is crucial for investors seeking good opportunities. Moreover, timing is a determining factor in identifying opportunities. This translation maintains the coherence and flow of the original text while ensuring it's easily understandable for a native English speaker. Sometimes, a company may be undervalued during a crisis, but it has strong fundamentals that suggest it will grow once the situation stabilizes. Therefore, having patience and a long-term vision can be the key to capitalizing on these opportunities before they become evident to the broader market. Finally, diversifying your sources of information and staying constantly updated on market trends helps an investor avoid missing valuable opportunities. Attending seminars, reading books, and following industry experts are effective ways to stay informed and prepared to identify the best investment options. Discipline in evaluating companies is a fundamental aspect of making informed decisions in the world of investments. One of the main tools for this evaluation is the use of financial metrics, such as the P/E ratio, price-to-earnings ratio, and cash flow. These metrics allow investors to understand whether a company is overvalued or undervalued relative to its actual financial performance. The P/E ratio, for example, measures the relationship between the stock price and earnings per share. A low P/E ratio may indicate that a company is undervalued, while a high P/E ratio could be a sign that the market has high expectations for the company's future. However, it's essential to compare these metrics with those of other companies in the same sector, as each sector may have different averages that influence the interpretation of the numbers. Cash flow, on the other hand, is another crucial metric because it reflects a company's ability to generate cash from its operations. Positive cash flow is a sign of financial health, while negative cash flow may indicate issues. Analyzing cash flow can also help understand how the company is utilizing its resources and whether it's investing in areas that could generate future growth. In addition, discipline in evaluating companies involves conducting qualitative analysis, which considers factors like the company's competitive position, management quality, and market trends. While these elements may not be easily quantifiable, they are equally important for a complete understanding of a company's investment potential. Finally, maintaining a disciplined approach can help avoid impulsive and emotional decisions that could lead to financial losses. An investor committed to rigorously and consistently evaluating companies is better positioned to make informed choices that can result in successful long-term investments. Strategic diversification. When it comes to investments, diversification is a fundamental concept that cannot be ignored. Imagine you're at a restaurant and decide to order just one dish. If that dish isn't good, your meal might be ruined. This translation ensures that the text is easily understandable and maintains the coherence and flow of the original, making it accessible to native English speakers. The same applies to investments. Concentrating all your capital in a single stock or sector can be risky. Diversification allows you to spread your investments across different assets, sectors, and even geographies, helping to mitigate risks. So, if one investment doesn't perform as expected, others might offset that loss, ensuring greater stability for your portfolio. An effective diversification strategy involves choosing assets that aren't highly correlated with each other. For example, while some stocks may be tied to the economy's performance, others, such as bonds or commodities, may behave differently during a crisis. This means that by diversifying, you create a shield against market volatility. The idea is that instead of seeing all your investments lose value simultaneously, you have a mix that can withstand different economic conditions. Furthermore, diversification can maximize returns by allowing you to take advantage of growth in different sectors. For example, while the tech sector might be booming, other sectors like healthcare or renewable energy could also offer significant opportunities. Investing in a variety of sectors can provide a more robust growth potential and a more balanced overall return, allowing you to benefit from different market cycles. A practical way to diversify is through index funds or mutual funds, which offer instant exposure to a wide range of stocks or assets. This is especially useful for investors who are just starting out and may not have the time or knowledge to select each asset individually. These funds are managed by professionals who have access to analyses and information that may not be available to the average investor. Finally, it's important to remember that diversification doesn't just mean having a lot of investments. You need a strategic approach, considering the proportion of each asset in your portfolio and its ability to generate returns. By diversifying intelligently, you not only protect your capital but also open doors to new growth opportunities. Reinvesting profits is a strategy that many successful investors adopt throughout their journeys. When you earn gains, the temptation to spend them can be strong, but it's important to consider the growth potential those profits can generate if reinvested. By reinvesting, you not only increase your initial capital but also enhance the power of compound interest. This means that each time you reinvest, you are creating a foundation for your investments to grow exponentially over time. A practical example of this is an investor who receives dividends from their stocks. This translation ensures the text remains coherent, cohesive, and easy to understand for native English speakers. Instead of withdrawing these dividends for personal expenses, he can choose to reinvest them or invest in new opportunities. This way, he increases his stake in the company and, in the long term, can reap even greater benefits. This approach not only maximizes returns but also demonstrates a long-term mindset, which is essential for any investor. Furthermore, reinvesting profits isn't limited to dividends alone. If you sell an asset for a profit, instead of withdrawing that money, consider reinvesting it in another promising opportunity. This practice not only helps keep the capital flow active but also allows you to capitalize on new trends or growing sectors that may offer higher returns than previous investments. It's important to remember that a reinvestment strategy should be accompanied by careful analysis of the available opportunities. Not all investments are equally attractive, and it's crucial to make a thorough assessment before deciding where to allocate the profits. This involves looking at past performance, future prospects, and market conditions, ensuring that you are making informed decisions. Ultimately, reinvesting profits is a powerful way to build wealth over time. By turning gains into new opportunities, you not only protect your capital but also make it work for you. When combined with a disciplined and diversified approach, this strategy can lead to a more robust portfolio and a successful investment journey. Adopting a long-term mindset is a crucial aspect of investing that many beginners tend to underestimate. Many people enter the market seeking quick returns, driven by the prospect of immediate gains. However, this approach can lead to hasty and often harmful decisions. When it comes to investing, patience becomes a virtue. Investors who focus on long-term goals tend to make more rational and informed decisions, thereby avoiding the trap of emotional reactions to short-term market fluctuations. Having a long-term vision doesn't mean ignoring changes in the market. It's important to be aware of trends and economic conditions that can affect your investments. However, the focus should be on building a solid portfolio that can withstand temporary crises. This involves choosing companies with strong fundamentals and a sustainable business model. These characteristics indicate that the company has the potential for enduring growth, even if it faces short-term challenges. A long-term strategy also helps avoid the information overload known as overtrading. This translation maintains the coherence and flow of the original text while making it easy to understand for native English speakers. When investors try to adjust their positions based on daily market news, they may end up making unnecessary trades, which not only takes up time but can also result in additional costs from fees and taxes. Focusing on investments that you believe will thrive over the years allows for a more relaxed and less stressful approach. Moreover, a long-term mindset encourages the habit of reinvesting gains instead of withdrawing them for immediate spending. This can lead to exponential portfolio growth over time, thanks to the power of compound interest. Rather than settling for short-term returns, investors who keep their profits invested can watch their money work for them, generating additional income. Finally, cultivating this mindset requires a shift in how you measure success. Instead of evaluating your portfolio's performance on a daily or monthly basis, it's more productive to assess your progress over longer intervals, such as quarterly or annually. This not only helps maintain motivation but also allows you to see the impact of your decisions over time. Monitoring and adjusting your portfolio are essential steps every investor should incorporate into their routine. While having a long-term strategy is important, ignoring market changes and personal circumstances can lead to outdated decisions. Therefore, it's crucial to review your portfolio periodically to ensure it remains aligned with your goals and strategies. During this monitoring process, you should assess the performance of each investment. Some stocks may not be performing as expected, and this is where critical analysis comes into play. Evaluating whether the reasons behind your initial investment still hold true is crucial. If a company that once seemed promising starts showing signs of financial weakness or market shifts, it might be time to consider selling, even if it goes against the desire to hold a long-term position. Additionally, monitoring involves keeping an eye on your portfolio's balance. Over time, some investments may grow faster than others, leading to an imbalance in your asset allocation. This can increase your portfolio's risk, as you might become overly exposed to a specific sector or asset. Adjusting the allocation to maintain healthy diversification can help mitigate these risks. Another important aspect of portfolio adjustment is adapting to changes in your life circumstances. Your financial life can undergo significant changes, such as a job change, increased expenses, or new financial goals. This translation ensures that the text is coherent and easy to understand for native English speakers while maintaining the original meaning and intent. What once served as a solid investment strategy might no longer be suitable after a personal change. Therefore, it's essential that your portfolio reflects your current circumstances and future ambitions. Lastly, monitoring and adjusting your portfolio offers the opportunity to learn from experience. Each review provides insights into what worked and what didn't, allowing you to refine your approach over time. This practice not only enhances your skills as an investor, but also contributes to more effective risk management, ensuring you're always a step ahead in your investment decisions. Now that you're familiar with Warren Buffett's 6-month strategy, it's time to reflect on how to apply these principles in your life. Think about how small changes in your financial decisions can lead to significant transformations in the long run. Are you ready to start this journey? Remember, success doesn't happen overnight, but with focus and determination, you can get there. Imagine yourself revisiting your goals and adjusting your investments with the same discipline that Buffett applies. What habits can you change today to ensure a more prosperous financial future? What if you started following these tips right now? Additionally, don't forget the importance of continuous learning. How about dedicating some time every day to read about investments and finance? This can make all the difference. Now, leave a comment on how you plan to implement Buffett's strategy in your life. What investments are you considering? Let's build a community of success and overcoming challenges together. And stay tuned, because in the next video, we'll bring more valuable tips to accelerate your journey toward wealth. Until then, stay focused and determined.